we live? We are live. I can confirm we're live. Oh, man. How is everyone doing today? I know if you're a long-only investor or long-only trader, you're not having fun right now. But it's okay. That's why we do this show. Just to lighten the mood a little bit. Let's just lighten the mood. We'll talk about the market. We will be bullish about some things, bearish about others, and oh, whoa. That was bizarre. And they're saying I have mic issues, Rohan. Do I have mic issues? Is it here? Watch this. I'm gonna move. Watch me move.
Oh, look at this. Oh. How's that? Is that better? Can you all hear me now? All right. This is how we're doing the show today. We're doing the show very without planning, very just sporadic, spontaneous. Whoa. All right. Yeah, Aaron Bree is like, I don't even know where Aaron Bree is. He's not here, is the point. He's out of the office today. I think he's in New Orleans. We're coming back from New Orleans. So I missed you guys, though. I was out Thursday and Friday, and I missed you. I wanted to talk about the market, and none of my friends really cared about what I had to say about any of that. I also made a really good joke. We were driving on a shuttle bus or riding, and we were on Embassy Row. I was in Washington, D.C. We're on Embassy Row, and we drove past the Japanese embassy, and I made a great joke about the yen, and nobody laughed. But surely I know you would have appreciated my joke if you had been there. But no one I was with appreciated my joke. So, again, this has been Benzinga Live. What's up, everyone? What's up, Aaron, Tiny Pie, Zoltan, Shelly, Aaron? Yeah, I get it. Enver, how we doing? Happy. How's everyone doing? Zen Bullish. So many beats. Vaughn Williams, how we doing? All right, here's the plan for today. We're gonna have a few guests. I've got a few guests ready to roll. Our first guest is not going to be for a little while. So it'll be you and me for a little bit, and then beginning at 12:15. I want to say 12:15. Yes, 12. No, I'm sorry. At 12 on the button at noon, we're gonna have Thomas Fennimore from Luminar Technologies on the show. I hope Matt Hammond can join us today, although I'm doubtful that he can. He emailed me a couple hours ago. He's stuck at the doctor. So if he's home in time, great. But if not, then he will have to join us tomorrow. Jake Wujastyk will come on as always from TrendSpider at 1 o'clock. We'll have Shawn Cruz from TDA on at 1:30, and that's gonna be the show. This is gonna be a very lax, rather unplanned show. I was out of the office for like 4 days. It felt like, so I'm still catching up, because for every day that you miss, it feels like it takes a day and a half to catch up. Right. In terms of just the market, I feel like. So I'm still not quite caught up on what the heck happened last week. On Thursday, for example, we took off. It was I don't know, 10:30, 11. Market was down. I knew the market was down. And we land, it was an hour and 10 minutes later. And I hop on Twitter, and everyone is in panic. Right. That's what it seemed like to me. I don't know about you all, but it just seemed to me that everyone was in just panic mode. All the gains from Wednesday were gone. And I thought, oh, man, I'm sad that I'm not at work right now, because it would have been a good day to be at my desk and talking to you good people. So that's all right, though. I'm here now. We can talk about it. We can talk through our feelings. You guys have feelings? I have feelings, too. about things. Charlie, no, I was at a wedding. It was a Friday wedding, and I was there for 3 days. I was there Thursday, Friday, Saturday. I guess 4 days, Sunday. What I missed on Thursday, guys? How was trivia? Oh no, you guys didn't do trivia. You guys did a new game. I heard it was amazing. I'm sad I missed it. We'll have to do that this week. Anyway, smash that like button. Let's roll the intro here and let's get started. This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wujastyk from TrendSpider. We have a
breaking news.
All right, I'm gonna bring on my pro right now. Let's just start with the watch list, right? Man, is that brutal or what? Everything red. Everything down today. No, not what's that? Staples? Not staples. Consumer staples are up. Breaking news. Holy moly. There's no mercy. It's a recurring theme. Let's go to the charts. Let's start with the Qs, right? We were just at the low of the day a few moments ago. Hey, we're getting a little bit of a bounce. That's something. Holy moly. All right. Where are we on the Qs? Are we at the March 2020 low? No, we're not. Oh wait, no, not even close. The March 2020 low is a ways away. Yeah, we're not even close to that. All right. That'll be crazy. That'll be something, right? When we get, or maybe not, I'll just say if we get to the March 2020 lows, which in the case of the QQQ is 170. Holy, can you even imagine the washout if that were to happen? I would just say this. I'd back up the truck at 170 in the Qs. I know that's a long ways away. We're back to where we were a year ago, right? Or a little more than that in the NASDAQ. So 14 months ago. 14 months ago in the NASDAQ, SPY, same story, basically. It is tough, right? It is tough out there because I was just saying this with Jim on the Future Show is typically when you get periods of weakness, there's an entire school of thought on Wall Street or in investing that diversification can protect, not will, but can. It can protect you in volatile markets. When one portion of your portfolio is getting crushed, the theory goes that another should pick up the slack in some way, shape, or form. There really isn't a lot of that happening. Everything is kind of moving in the same direction right now, which makes it really frustrating for people that are like, oh, I thought I was diversified. I own U.S. stocks and I own emerging market and developed market stocks. I own stocks and I own bonds and I own commodities and I own crypto. And I've got small caps and mid caps and large caps. And it doesn't matter because nothing is outperforming. I mean, sure, I guess there are degrees of outperformance relative to the indexes. But if you look year to date, right, and energy, which has been the story of the year, let's pull up the XLE chart. All right, energy has been the story of the year. At least it was the story of the year. I guess in some respects it still is. Oh, you see, this is what I'm talking about. See, I didn't even realize that we had that rally on Friday. I had no idea that the XLE made a new high on Friday. All right, so yeah, XLE clearly still a story of the year. but there's not much else to like. Yeah, but that's my point too, Easy Mike, is like there's nowhere to hide. I guess XLE, you can hide there. Hold on. Rotation is no, I don't agree. I know why you'd say this, Enver. I don't agree with that though. I'm saying it's not working right now. It definitely can work. It's not working right now. Everything it's sort of like it's a less extreme version of what happened in March 2020, right, where everything went down at the same time. Now that was a crash and then a bounce, which is not what we have now. We have more of a steady decline, a roll down the hill, if you will. But I mean, you can't go into bonds. You can't buy bonds right now. Bonds are unbuyable. They're less buyable than stocks, frankly. Oh, thank you, Happy. See, this is why I love you guys, because I wasn't here. I was not watching the market on Friday. I was at the National Archives in Washington, D.C., trying to steal the Declaration of Independence. I did not. I was unsuccessful, for the record. So thank you. That's helpful color. That I didn't realize that that was just a late rally. Yeah, okay. I mean, UUP is the answer. The dollar, right? The dollar trumps all. The dollar is everything. But like, if you go look and do a screen for like the best performing ETFs / ETNs or whatever for the year, you will see it is exclusively energy funds and like inverse tech funds. Like that's what we spoke with Dave Mods about this last week, right? It was like all the inverse funds that Direction has are like ripping, and those bet against the market. So it's essentially the equivalent of taking a short position, and those are all right. So you can hide there, but you can't hide there for too long because they're not designed to be held for more than a couple days or a week or so, right? I guess you can hide in the UUP, but can you really go to cash when inflation is at like double-digit percent? I know what the official reading is, 8.5, but we all know it's more than that. Nowhere to hide. Can't hide in crypto. I have to admit, I know we look at crypto every day, and I've been buying. I've told you guys this. I've been buying crypto. I've been buying Bitcoin and Ethereum in small amounts every single month. I've just had an automatic thing on Coinbase. I'm getting to the point where I think I want to stop, right? And I know that's counterintuitive because in theory, if I have a long time horizon, I should want to buy at lower prices. But it's so difficult. It's one thing to know the quote unquote smart thing to do, but it's another to just be able to do it psychologically. I don't know if I can keep buying Bitcoin down like this, right? Yeah. The time to buy is when the blood is in the streets, even if the blood is your own. But from a psychological standpoint, it's so I get it, man. I get it. I get why nobody wants to buy. If you're in any of these growth stocks, any SPAC, you're in ARKK. Let's do ARKW because I'm in the ARKW. I get it. It is freaking insane. And this is why when people say, why don't I just put all my money on a stock or all my money on these two stocks or on this coin or whatever it is, the answer should always be don't do that. Because if whatever it is that you're betting on falls by 40%, half, you don't know what it's like to lose half your money until you lose half your money. No one can tell you. You have to feel it for yourself. So if you're in ARKW, let's say you bought this thing at the end of wait, what was the stat that I gave? The stat that I gave a few months ago was that most of the flows happened at the end of 2020, right? Or early 20. I think most of the flows like happened in this general window, which makes sense because that was the all-time high. And just look at the volume, right? You're in this thing from like $150. You just lost 2/3 of your money. So I totally get it. I get why people are Shelly. Maybe Matt Robert is right. You buy Sark and chill, but nothing works forever. Sark is working. His timing was amazing. Look at that. But again, inverse tech. This is not going to work forever. I feel like kind of a pot saying that. And but I felt this way too with ARK in 2020. And I'm long ARK, right? And I remember just like thinking like it's not going to work forever. And I almost, like, as somebody with a long time horizon, I almost don't want to see that crazy rally. I'd rather see, 7% a year, 8% a year. That's boring, but it gets the job done. When you go up from 49 to, what was the all-time high? To 191 in 12 months. Yeah, you got to expect a pretty vicious pullback. And that's what we got. So with regards to SARK, because it's working, right? Congratulations if you own SARK. Seriously, if you own it, you deserve it. But know that nothing will last forever. This will not go up forever. That's just the way things go. I don't listen to Rich Dad Poor Dad Zen. I think he's kind of I don't know. I think I don't like some of his advice, so I don't listen to him. Everyone's free to listen to their own people. That, if you like him, great. He's not really for me. He kind of just got rich off real estate, I feel like, and that won't be me. So anyway, SARK, great looking chart, beautiful. Should I have bought it? Of course. Maybe we can still buy it. Here, let's go to a daily chart. The problem with SARK, so the problem with this is, like, I have learned my lesson the hard way many, many times, not to buy things when they're ripping. If you want to buy it for a trade, I'm talking about for a trade, right? Because that's what this would be for me. If you want to buy it, wait for a dip. Like, if you want to buy this SARK for a long-term thing, which I would highly recommend against doing, but you do you. If you want to buy it for a long-term thing, then just go ahead and do it, right? What is the difference between buying SARK at 68 and buying it at 65 or 60? Nothing. If your time horizon is a year or more. But I would highly recommend, if you're going to own SARK, don't buy and hold this thing, okay? This is an inverse ETF. It uses swaps. It has fees, okay? If ARKK, which is what this is based on, if ARKK starts to bottom, which I know seems implausible right now, it seems implausible, I know. But if it does start to bottom here, SARK will get crushed, all right? Just because of the nature of the leverage. So SARK, not a buy and hold long-term investment. Great day or swing trade vehicle. Congrats to anyone that owns this thing. Yeah. So again, as I was saying, if I were to buy this, I would buy it on a pullback. I would wait for 65. What was the close on Friday? Well, what was the high on Friday? 65, 66. 66.03. Right? And the close was what? 63.84. I would buy it somewhere around 65, 64 for a swing long. That's me. Right, exactly, Michael. Now some of these high growth stocks are never going to recover. Like growth as an asset class, growth as a factor, right? That's what it is. It's a factor. It's a characteristic. Growth will recover, but many of these growth stocks will not recover. Okay, like you guys see Ride today? I know I'm picking on low hanging fruit here, but this is probably, and again, it doesn't say a lot with the stock at $1, but like Ride's probably a zero. My honest take is if you own Ride, it's a zero. Okay, sorry, that's my opinion on Ride. Not all these are going to be zeros. Like, is Rivian a zero? I don't know if Rivian is a zero. What's the market cap of Rivian? $25 billion. It's still very expensive, frankly. I don't know if it's a zero, but it certainly can go lower. Like Fisker. I know I'm picking on EVs now. I know there are others, right? Is Fisker a zero? It could be. It could be. It really just depends on production. Like, is SoFi a zero? I don't think so. I could be wrong. I could be very wrong here. But that's what happens when you buy individual stocks, right? Sometimes they go to zero. I saw the headline today that Goldman Sachs is pulling out of all SPACs, which is not a great sign. Okay, let's address this comment. If you missed pre-market prep today, and I'll forgive you if you did, I read a small snippet from a letter that the CEO of Uber sent to his employees, I guess over the weekend. And this letter obviously leaked to the media, as it is wont to do. And I read a snippet. I want to read this snippet again. I'll read a little more of it. I'll read more of it. Let's bring up the Uber stock here. And again, this is from Dara. His name is difficult to pronounce. I apologize. Dara Karshwashwahi. I hope I got that right. I'm sorry. Not my strong suit. This is a letter that he sent to a whole Uber company today. And I think we can extrapolate this and apply it to every tech company under the sun. Team Uber. After earnings, I spent several days meeting investors in New York and Boston. It's clear that the market is experiencing a seismic shift and we need to react accordingly. My meetings were super clarifying, and I want to share some thoughts with all of you. As you read them, please bear in mind that while investors don't run the company, they do own the company, and they have entrusted us with running it well. We get to set the strategy and make decisions, but we need to do so in a way that ultimately serves our shareholders and their long-term interests. And then this, I think, is the key point. Okay. He outlined like 7 key points. I'm only going to read point number 1. All right. In times of uncertainty, investors look for safety. They recognize that we are the scaled leader in our categories, but they don't know how much that's worth. Channeling Jerry Maguire, we need to show them the money. We've made a ton of progress in terms of profitability, setting a target of $5 billion in adjusted EBITDA for 2024, but the goalposts have changed. Now it's about free cash flow. We can and should get there fast. There will be companies that are slow to pivot. That put their heads in the sand and are slow to pivot. The tough truth is that many of them will not survive. I'm going to stop there. Now it's about free cash flow. I'll say it again. And we should get there fast. Free cash flow. Okay? Investors want to see Bottom line, they want to see you making money. They don't care about all the money coming into the door. They care about what's left at the end of the day. Is your business profitable, right? Metrics like EBITDA are very helpful, and free cash flow. These are metrics that show profitability. Profitability was never a concern. It was never a concern on Wall Street for the last 10 years. Okay, you could thank Amazon for that. Frankly, Amazon paved the way for. We don't care about bottom line earnings. We're going to show you that we're going to make so much money in revenue, and we're going to keep growing year after year after year after year that you're not even going to care how much we're investing in the future, because we're going to just be printing money. And it worked for them. And everyone followed suit, and Wall Street was like, oh yeah, revenue. Yep. Keep on growing. Grow, grow, grow. What's that scene from Silicon Valley that Aaron Brio always talks about, right? You don't want to make money. Making money is bad. Not making money is good. Well, now we're the other way, right? Now making money does matter, right? So to answer the question on the screen, when is the market decline supposed to end? I will give you a couple of thoughts on that, and then we're going to bring in our first guest. Thought number one, as soon as companies show that they can make money, that they have positive or at least free cash flow trending in the right direction, trending up, right? And two is when valuations just come way down, right? I guess the third idea would be if inflation were to suddenly come back down. If inflation were to come back down to where it normally is historically, right? 4%, whatever, somewhere in that area, 3%, that the market would probably love that. I'm assuming. But the bottom line is, we investors are re-rating the market right now. And with that comes a lot of uncertainty about what is a fair price for this stock. Is it really worth what it's worth today? Is that really true? For a lot of companies, the answer is no. There's still more room to go. And this is a great segue actually into our first guest of the day, because he is a CFO, and these are the kind of things that he has to deal with. Tom Fennimore, he is the CFO of Luminar Technologies, ticker LAZR. If we can, let's get Mr. Fennimore on the show right now, please. Mr. Fennimore, how we doing today?
Spencer, we're doing great. Spencer,
hold on
good
one
to see
second.
you
I'm
again.
going to grab a different pair of headphones. 1 second, because
Okay.
I can't. Your mic is good, but my headphones are busted. So my producer's going to grab me some more headphones right now, because I can't hear. But they can hear you, which is what matters. So let me just start with this question. As a CFO right now, what is your focus, right? You're managing a company's, there's producer Ron, managing your company's financials. I just read a snippet of the Uber CEO's letter that he sent to the whole team over the weekend, I guess. But talk us through where your head is at right now as the market re-rates everything.
And Spencer, it's a great question, and I was listening right before I joined to what you were saying and couldn't agree more. The reality of the situation is that if you're only starting to make moves now to address the situation that you're in, you're too late. And I started off my career on Wall Street. I worked on Goldman Sachs's equity capital market desk during the dot-com boom. And I saw this wave of IPOs with anything with a .com attached to its name go public. And then eventually the market said no more. There was a big crash. a lot of those companies went away, and those that had a real underlying business and that had enough cash to survive the storm, those were the Amazons and the eBays and the Googles of the world that emerged as the winner. When we went public at the end of 2020, we prepared for the worst and hoped for the best. We also did a major convert fundraising at the end of last year. And so we have over $700 million of cash on the balance sheet. We've had enough commercial success that you can actually see a path to profitability for us once we get to start a production at the end of this year and start launching this business that we've won. And we've also been attracting the right team to allow us to execute. And so we took the steps over the last 2 years to make sure that we have this very strong balance sheet to survive this storm that we thought could come. Now, unfortunately, it came. We were hoping for the best, but luckily we were prepared for the worst. And so this is going to be a tough environment. If you don't have the capital today, it's a very tough environment to go out and raise it. And the market is in the stage where it's just shutting down for certain names and for certain types of companies. And one of the things we kind of track for the other LiDAR and autonomous software companies out there is we look at their cash burn rate. We look at their forecasts that Wall Street research analysts provide. We look at their cash that they have on the balance sheet. And there's going to be a large number of these companies that are going to start running out of cash around the end of next year. And so going back to what I said earlier, unfortunately, unless you've kind of taken the steps prior to this tough market we're in to go out and raise capital, it's almost too late. And, this is going to be, as we're starting to use the phrase internally, war of attrition. And you got to make sure that you have the tools in hand and the people in hand and the capital in hand and the business in hand to survive this.
So what metrics are you laser focused on? What financial metrics? I mean, what parts of the balance sheet or of the income statement are in your eyes and in the eyes of the investors you talk to the most important right now?
So in the near term, it's what I would call we call it our cash spend.
Okay.
Some people call it the cash burn. For the finance geeks on the phone, it's the operating cash flow less CapEx. So it's the totality of the cash that you need to spend to invest in your business. It's not only EBITDA, but you got to incorporate the CapEx in there as well. And then we look at that cash burn rate or the cash spend rate relative to the cash that we have on hand. So last year, our cash spend was $155 million. We ended the year with $792 million in cash at the end of last year. So if you just take your total cash balance divided by your annual spend, that's 5 years, right? So we got 5 years of cushion, assuming we make no improvements in our cash spend. At the end of this year, we should get the series production. That will significantly start to ramp up our revenue, and that will, should cause our cash burn rate to decline as a result. And so we're very confident that we have enough cash, what we need, plus a very healthy cushion to get there. So in the near term, we raised the capital and we're being very disciplined on the spending. Now we're investing what we need to, but we're also not going to be investing in unnecessary costs. In the medium term,
sorry, go ahead. No, go ahead. Please.
In the medium term, it's what you talked about. It's that path to profitability that investors want to see. We're in a market now where it's not, they don't want to hear the tell me story. They want to see the show me story. And so in the medium term, it's in 2023, ramping up our series production, managing that growth, managing our unit economics to a cost where we can reach profitability shortly thereafter. That is going to be an important analysis and discussion that we're going to need to have with shareholders. We'll probably start having that towards the end of this year. But the point is the near term, manage the cash, medium term, successfully launch series productions and start getting to that path to profitability. And then in the longer term, you want to maximize that profitability.
It's a tricky line for you, right? Because you obviously want to invest in the future. You want to invest in your business, but we're at a point right now where, like, at least like Wall Street, and you can argue whether it's right or wrong that they think this way, but they think it. They don't want to. They don't want to see you saying, "Yeah, don't worry about it, guys. We'll talk to us in 5 years." They don't want to see that right now. Which is part of the game, right? You obviously know this as a Wall Street guy, and you know this as a CFO is the mood changes. So in terms of your own internal numbers, in terms of your goals as a company, just financially, in terms of product goals, in terms of the guidance, the forward year outlook, talk us through that and where you are in relation to the goals that you've outlined on your earnings calls and such.
Yep. And so we shared on our earnings call, which we did on Thursday, that we're on track to meet or exceed all the goals that we set this year. The first two are reaching series production readiness for both our Iris, which is our core LiDAR hardware, as well as getting to a beta release of our Sentinel software package. The other two relate to continuing to grow our commercial pipeline. We said that we wanted to grow our number of major commercial wins by 40% this year, which implies more than 4. Through April, we had 2 big wins that we're proud of. One is Mercedes-Benz, which we announced earlier this year, and then most recently with Nissan, where Nissan said they're developing their next generation safety system, which is going to be a lot better than what's on the road today. And it's going to be, led by the Luminar LiDAR. And their goal is to put that on virtually every vehicle that they make by 2030. And this is what Nissan said to the public. And then from that, we also want to grow our order book, and we want to grow that by at least 40%. We're also on track to meet the financial guidance that we set this year, most notably to grow our revenue to 40 million plus. And so the team's doing a great job. The market's tough, but what's really driving the market and stocks like ours is, as you said, this market shift to near-term profitability metrics, but most importantly, what's going on geopolitically with the Ukraine and with China, as well as the Fed fighting inflation. And so to a certain extent in the near term, our performance is probably not going to be the biggest driver of our stock price. It's going to be what the Fed is doing and what's happening geopolitically. But the message to the team is keep our head down. We got the tools we need. Let's control what we control. And if we're successful, the stock price is going to be a lot higher, in the medium term.
I know you can't get bogged down in the short term, but does it frustrate? It's got to frustrate you a little bit to come out and say, look, we're trucking over here. Things are coming along, right? We're doing what we say, and the market doesn't care for now.
Yeah,
it's got to be a little frustrating.
I would be lying if I said it wasn't frustrating. But to a certain extent, as the leadership of the company, we got to keep the employees and everyone focused that we control our destiny. We have, we control it. It's all executing. Let's not get distracted by the short-term stock price. While it's human nature to always look at that, we have what we need. We, as I always like to say, our largest shareholder who controls our company and owns 30% of it, he's 27. And so we have the luxury of taking a longer-term view because that's what our largest shareholder wants to do.
The longer-term view is it's probably better to have a longer term view. So that's what most investors want to hear anyway. So it's good it's good to hear that. I guess what was the biggest takeaway from the earnings report last week, or what should we have? What should our biggest takeaway be from your earnings report or even the conference call from last week?
So I think that Nissan made this big announcement at the end of April, and they made it mainly in Japan. And while the news has started to filter its way over here to the US, I don't really understand I don't know if the market fully appreciates how big this news is. Yes, it's big from an economic perspective and a unit volume perspective just given what Nissan has said out there about eventually wanting to deploy this to every vehicle that they make. And, for reference, Nissan made 4 million vehicles last year. But one of the things that we're big believers here in at Luminar is we want to democratize vehicle safety. There's over 1 million deaths on the road globally each year. And our technology wins so far have really been with the luxury and the premium vehicle makers. And that makes a lot of sense, where technology usually starts at the upper end of the spectrum, then makes its way down. But for us, in order to achieve our vision of saving a lot of lives, you really need to find a mass market brand to introduce your technology. And so with Nissan doing this, that really helps us achieve our vision. And so that's a win that we're very proud with here at Luminar. And our goal is to put our technology on every vehicle, because at the end of the day, we think it's going to save a lot of lives and save a lot of productivity.
And again, this is a long-term thing we're talking about, because we're talking about mid-2020s, right, for the development, right? And then we're talking like the end of the decade for when it's actually in the cars, right?
Yep. Look, it'd be great if this volume was ready to go tomorrow, but the reality of the automotive industry is that you typically need to spend 2 to 3 years after you win a piece of business to develop it. Luckily, in the meantime, we have several customers, including Volvo, SAIC, Polestar, Mercedes-Benz, Mobileye, that will be launching and providing a lot of growth in our volume and revenue starting around the end of this year.
Yep. All right, Thomas Fennimore, the CFO of Luminar Technologies. You can see the ticker, you can see the chart up on the screen, LAZR. Tom, any other thoughts for us just before we hop? Are there any? Was there any other nuggets from the call that maybe didn't get hit on enough that you want to get to cover again?
The only other thing that we mentioned is for those near-term launches that we're seeing with our first wave of customers, they're coming to us and asking us to be prepared to launch at a higher run rate in terms of when they reach SOP. And so we've been working with Celestica and really planning to launch in their shared facility, where they not only make products for Luminar, but several other customers in the typical contract manufacturing model. Those volume guidance from our customers have now exceeded the available capacity at Celestica. So we'll be working with them to build out a dedicated facility, right down the street in Monterey, that will be up and running by the end of the year. So, that's, once again, it's one of those things where, it's not going to lead necessarily to near-term profitability this year, but I think it reinforces the growth that we have coming here at Luminar.
How are you doing on the supply chain front?
So right now, we made a decision at the end of last year that we were going to pay a little bit more in expedition fees and a little bit more in inventory costs to make sure that we have the supply chain in place for this year. And so for this year, look, there's always a risk, but not something that keeps me up at night. We also went out last year for our most complicated chip, the InGas one. We actually, as part of the optimization deal we did, that was, we have our own foundry there, so we can control the ramp up of that. We still need to go out and buy our own silicon chip, but we're doing what we can to manage the supply chain and make sure that that's not going to be an issue in 2023. It's something we're focused on, but as I said, not at the point yet where I'm losing sleep over that issue.
Awesome. Is there anything you are losing sleep over? Anything work related? I don't know about what's going on in the other parts of your life.
I still have 2 young boys, and so they're always fun, fair. But they always find a way to, bedtime could be a little easier, but it's always fun as a father to do that.
Fair enough. All right, Tom Fennimore, CFO of Luminar. Tom, always a pleasure. Have a great rest of your day.
Spencer. Good to see
you. As Tom and I were talking, take a look, everyone. Look what's happening. We bounced. Just a little bit. Not even quite to where we were at the open, but hey, a bounce is a bounce. Frankly, just from a psychological point of view, I don't even necessarily care if we get back to like scratch today, right? It's just nice to see the market not go straight down, right? Like, that's why I suspect Thursday was so depressing. because it's just like straight down. Like I guess we technically went sideways for a couple hours there, but more or less straight down. That's just like tough to stomach from a psychological point of view. So it's nice to see it bounce. What's up with Twitter? Oh, wow. Okay, so this was a Hindenburg report, right? Hindenburg is short Twitter. Is that what I saw? They're short Twitter because they think that Elon has all the leverage. And if he wanted to, he could say, I don't want to pay $54.20. I want to pay $48. Right? Did I get that right, everyone? That seems like what the gist of this short report was. Anyway, you guys know I sold my Twitter on, what day was it? Was it Tuesday or Wednesday of last week? I owned it for like a whopping like 4 days. Took I think a 50-cent loss on it. Was trying to do the risk arb again because you have some clear upside here, right? If the deal goes through as it stands, it's $54.20. You get a nice $6, $5.50 on that. But the longer I waited and the more noise there was, I just thought, I don't need any part of this. I don't need my trade to hinge on the word of one man. So we've said this before. We'll say it again. If the deal doesn't go through for whatever reason, Twitter's going to $30 in a heartbeat. That's unfortunate, but that's the way it is. If you're in Twitter, you've got defined upside and undefined downside. So we'll see how it checks out. But I'm out. Hands off Twitter. As far as I'm concerned, it's over. All right. Because either it does get bought and it goes private, and that's that. Or the deal collapses and it goes to 30. Either way, I'm out. So, yeah, happy. I'm with you. Well, I know what tweet you're referring to, but his whole Twitter scares me, frankly. Every tweet he does in the aggregate scares me. I think he's just being dramatic. Also, the guy works like 20 hours a day. He tweets like inane stuff. I think that's kind of the charm, right? A little bit. That's part of the point. Okay. Where are we here? We're going to have, again, Matt Hammond, I hope can join us, but I don't think he can. If that's the case, he will, he'll be on, I hope, tomorrow's show. Let's do this, though. Let's take a quick look at the crypto heat map and see how we're doing in crypto land. Obviously, I know we're down, but are there any pockets of green? Let's find out if there are any pockets of green in crypto land right now. All right, here's the heat map. I'm bringing up on the screen. It's on benzinga.com/crypto. As soon as I can scroll, there it is. Benzinga.com/crypto. Oh, Near Protocol. It's been a while since we called out Near Protocol on this show. The only crypto on this heat map in the green. It is remarkable how correlated the crypto market is, isn't it? I will say I fell for it. I fell for the idea that crypto was a hedge. It was an uncorrelated asset. I shouldn't have fallen for it because anyone that was there in February and March of 2020, you remember that the stock market went down and so did crypto. Crypto had like its potentially golden moment in the sun. Oh, to prove itself as an asset that didn't move with the rest of the market, and it did. So I fell for it again. I clearly that was wrong. I mean, Bitcoin is as correlated with tech as anything else. So on days when tech is getting crushed, Bitcoin and crypto at large should be crushed, as is the case today. Bitcoin down 5.5%, ETH down 5.25%. Solana which I bought. When did I buy Solana? In the 80s or 90s? Or over 100, perhaps? Down to $69.68. Just, you'll love to see it. You love to see it. You don't love to see it. Bitcoin below. Bitcoin just coming apart here. It's all psychological, right? And this is the argument that I made this morning on pre-market prep, and I'll kind of say it again. The same exact logic that applies to crypto on the upside also applies on the downside, right? All the bulls saying Bitcoin's going to 100 grand. I mean, nothing's stopping them from being right. There's no argument against that, but there's also no argument against Bitcoin to $10,000. They should be given the same weight because there's nothing fundamental here. The argument that I'm seeing more and more is like, oh, there's institutional inflows. No, just because Fidelity offers 401k or Bitcoin in their client 401ks doesn't mean there's inflows coming. It's all psychological. Okay, I own Bitcoin. I've been buying Bitcoin. I've been buying Ethereum. Maybe I'm going to regret that. I don't know. It seems bad now. Maybe I'm just overreacting. It's entirely possible. But you know what? I'm just glad that it's not me. I'm glad that I'm not one of these people that has half their money invested in crypto. And this is why I don't, frankly, this is why I don't make lavish bets. This is why I make small, because I can't take it. I can barely take it right now. I've got I don't know how much Bitcoin I own. A couple $1,000. I think I've got $5,000 worth of Bitcoin. A little more. I've got $8,000 worth of Bitcoin. Okay. Which in the grand scheme of things is not a lot of money. Okay. And I'm sweating over here. I'm sweating. I'm angry over my $8,000 Bitcoin position. Yeah, Brock, I might be even less than that. I don't know where I am, I'll be honest. I have to square up my different accounts. Just a pain in the butt. I couldn't take it. You got to know yourself, right? If you can take it, then hey, more power to you. Great. There's nothing wrong with that. If you're gonna put it all in red, and you can take the heat, then take the heat. I'm all for that. But know your own self. I know my own self to know that I definitely couldn't take it. Do I get pissed off that I didn't participate in the Bitcoin rally from $2,000 in 2018? Was it 18 or 17? It went all the way down to $2,000, right from 19 to 2, and then it went back to 50. Do I think about the fact that I didn't get rich off that? Sometimes. But on the plus side, I get to sleep better at night right now because I don't have all my money in Bitcoin. If I did, I'd be dying somewhere. So, as I said, I have been buying more every month. It's automated. I don't look at it. I don't look, so I don't know how much I own. Okay, that's the truth. I could look, but I just choose not to. And that's that. And I'm considering stopping. But that's where we are right now. Anyway, if you want some free Bitcoin, there is nothing better than free stuff. Okay? Free food, free Bitcoin, free stocks. Free is the best. If you want some free Bitcoin, I recommend you go to Voyager. You create an account with the code ZING when you sign up, ZING. You fund that account, right? So step 1, let's go to Voyager. Step 2, sign up, use the code ZING. Step 3, fund your account with at least $100. Step 4, make a trade, any trade. And step 5, they will send you $50 worth of Bitcoin. Check it out. Voyager, code is ZING. Or don't get free Bitcoin. That's fine too. I got my free Bitcoin already, so I'm good. Yeah, that's true, Solaire. The crash is a feature, not a bug. Well, that's why I don't own just Bitcoin, right? That's why I bought Ethereum. I bought Solana, not like understanding what it does. I only got it like a little bit, but I don't know. All right, maybe I'll keep going. Maybe I'll keep buying. I don't know, guys. It's a monthly thing anyway. It's only once a month. I have a few weeks to feel my feelings. Maybe I'll have one of the crypto boys try to talk me out of not. The crypto boy Logan over here. What does it say? It says anti-fiat social club. What does that say? Anti-fiat social club.
Yes, buy Bitcoin.
He says buy Bitcoin. Dude, the dollar is strong right now. I don't know if you know that. All right. The US dollar is crushing it, man. Okay, should I just close my eyes and just keep on buying? Maybe I should. Maybe that applies to crypto as much as it applies to stocks. Just keep buying. I'm not selling. Get real. Why would I sell? Why would I sell? At what point would you guys back up the truck? I thought about this weekend, right? Because I was like, well, yeah, let's pull up a Bitcoin chart so we can talk about it together. Because I thought like, oh, in theory, like if Bitcoin got to like 20, right, or 15, like I could say today that I'd back up the truck, but like, would I really though? Yeah, let's pull up a weekly chart of Bitcoin. Let's get that up on the screen. Like, would I really? If Bitcoin was at 20 grand, that means it fell more than 50%. Would I back up the truck on an asset that's down 50%? Probably not. If I'm just being honest with you. Let's go to a monthly chart here. Yeah. This only goes back to 2018. That's okay. Yeah, this is what I was referring to. So like in 2017, it went to 20,000, right? Or just about. And then a year later, right? That was December. So then a year later, it was at like 4K. And then of course it went to like 60. At what, this is a question I'm posing to you because I don't know the answer. At what point do you all want to back up the truck in Bitcoin? Let's just say it keeps on going. Let's just, for the sake of argument, let's say Bitcoin keeps on going down here. Assuming you buy on the way down. At what point do you just say, screw it. I'm going all in here. This is so stupid. This is so cheap. I'll take out a damn margin loan, a payday loan. Mitch says 8 to 10K. He would back up the truck. I'm taking answers. I'm surveying because I don't have an answer myself. Because in theory, I know that I wouldn't want to do it anywhere, frankly, because I would just see the trend and be like, why would I want to catch this knife? Logan Ross is all in at 30K. We may see that this week. I'm just being honest. Easy Mike is going for the other approach. He's going for the time approach, not the price approach. He's saying he'll buy in middle of next year. T Huat, I don't know how to say 15,000. It's a bit of a ways away. There's no right answer. That's the beauty of it. There is no right answer. There's also no wrong answer. $18 to $21. That seems reasonable. Spiro, 18 to 21. That was the first high, right, from 2018. That seems like a reasonable area to me, but again, I say that now, having bought Bitcoin at 50 and 45 and 40 and 35. So, I don't know the answer. I mean, I'll be honest. Frankly, things are way more fun when a crypto is going up. Like when crypto's mooning, it's just more fun. Even if those moons are short lived. I mean, it's fun watching Doge go to 60 cents, right? Where's Doge at now? Like 11 cents? It's fun watching that stuff happen. I enjoyed it. It's fun watching people like get rich, I think. Even if it's not you, I still think it's fun to watch. I just hope that people take profits at some point. Anyway, that's crypto. We don't need to talk about crypto all day because there's more to life than just crypto, I think. What do you guys want to talk about? I've sort of gone through my spiel here. As I was saying earlier, I think the metric to watch going forward, if you're looking at stocks, we got to watch free cash flow. We got to watch forward PE. And we got to watch like EBITDA or adjusted EBITDA, whatever the company says. I am by no means an accounting guru. I'm not going to sit here and tell you the intricacies of the difference between EBITDA and free cash flow. I know what they do, but more important than knowing the intricacies is just understanding the environment that you're in right now. And we are in an environment that values, as the CEO of Uber said it, show me the money. Show me that your business is profitable. Don't disguise your earnings with like ancillary stuff, like other investments that you've made that are paying off big time, right? No, we want to see that the business that you're in is making money. Subtract all your expenses, take away the payroll, take away whatever, the cost of doing business. And at the end of the day, are you left with anything? If you are, that's a good place to start from a business, right? Free cash flow is basically just a measure of that, right? So is EBITDA in a way, right? Earnings before interest, taxes, debt, amortization. Just strip away all the accounting stuff. They're similar ideas. So EBITDA, free cash flow. Is there money left at the end of the day? And then from a valuation standpoint, forward PE, right? It is not perfect. No metric is perfect, right? Forward PE has its flaws. But is your stock cheap or is it expensive? Is the forward PE high? Is it low? What would be high? It kind of depends on the industry, right? You really should only compare a PE of a stock to a stock in its category in the same industry or same sector. You really shouldn't compare the PE of Macy's to the PE of Apple. It's apples and oranges, right? It's Apple and Macy's. Two different businesses, two different things. Not really a relevant comparison. You do want to compare the PE of Macy's to the PE of Nordstrom or even like a Best Buy. It's all retail, or Kohl's. And again, different industries are assigned certain premiums, right? Tech for a long time got assigned a high premium. It's coming off now. So, we want to see some forward PEs in the 20s, right? Or lower. No more forward PEs in the hundreds. Hundreds is bad. Way too high. Gotta come in. Gotta come in. Ayn Rando says free cash flow is king. Free cash flow was not king for a decade. And in the last year plus, it has become king again. Patrick, are you going to be in Vegas this week? Who that's watching right now will be in Vegas this week? Besides me, I'll be in Vegas. I'll be in Vegas on Thursday. Thursday, Friday, Saturday, all day. I'm getting in at I think I'm landing at 1 a.m, Wednesday night. I'll be there for 3 whole days. Why, you ask? Because I'll be at FinTwit 2022, which I will say, I've said it before, I'll say it again, I'm ridiculously excited for. I was out of town right last weekend. I probably mentioned the fact that I'll be in Vegas 100 times last weekend. I'm so excited. If you don't know what I'm talking about, if you have no idea what FinTwit 2022 is, FinTwit2022.com. Get your ticket and come hang. Our next guest, Jake Wujastyk, he will be there. Nick Shaheen from our Options Inner Circle, he will be there. The list. Mark Minervini, who came up on this show naturally in conversation last week, he will be there. That was a late edition, so we're pumped for that. It's a who's who of some of the best traders that are out there. Brian Shannon will be there. Again, it's going to be awesome. I'm trying to decide like on the ratio of like entertainment to fun. I hope it's like 50-50. Like just education and fun. Like education during the day and just like massive fun at night. Just networking, socializing, maybe gambling a little bit with my life savings. So it's going to be awesome. If you're not going to be there, you're going to miss out. It's at the Aria Hotel and Casino, which is, I was there like a month ago. At least I walked by it. It was so nice. So we're so hyped. Luke Jacoby will be there. Neil Hamilton will be there. Aaron Breen, my co-host, will be there. It's going to be great. We're pumped. I hope you're pumped. So we're not going to be doing a show this week, Thursday and Friday, because Aaron and I are going to be in Vegas. So you're going to miss us. It's going to be amazing. Benzinga needs to come to Texas. Oh, that's a good idea. Hey, when is our next I'm talking to no one in particular here, but when is our next event after this? I think it's in the fall, right? Here, let's check. Because we were just in Miami a month ago. Now we're going to Vegas. Yeah, our next event is not until the fall. I think it's in New York, though. We have our FinTech Awards in New York in December. We have a cannabis conference in the fall. I think it's going to be in September. I think. I don't know if we know where yet. We should. I agree with you, Master of Songs. We should go to Austin or Texas. I don't. Doesn't matter. Austin, Dallas, wherever. We should definitely have an event down there. Let me talk to the powers that be about that, because we've had events. We've had events in New York, San Francisco, Chicago, Toronto, Miami, Detroit, obviously, where we are right now. I think that's it. So, Vegas now, of course. We'll get down to Texas. I don't know when, but we'll get down to Texas. Toronto, we had our cannabis event there a few years ago. It was awesome. We had a cannabis event like a month after Canada legalized cannabis federally. It was great. Okay, sorry. There was a great question in the chat that I got distracted by. Matt Robert asked, is 20 times free cash flow a good measure for market cap? A good assessment of whether a company's market cap is still out of whack, right? Is quote unquote too high, whether it's overvalued or not. I'm gonna be honest, off the top of my head, I couldn't tell you. Okay. Let's look up a company here. Let's do Apple. Okay. Let's look at Apple. All right. What's Apple's free cash flow? Apple's free cash flow, we'll just call it $105 billion. What's their market cap? So we go market cap of, we'll just round up, 2.5 trillion divided by free cash flow of 105 billion should get you 23, right? Apple's at about 23 times free cash flow right now. Apple is generally a good barometer of things. Okay, so your number was 22, Apple's 23. Yeah, that's a good bogey. That's not a bad bogey. Again, that was just my first example. That was the first stock I can do. We can do another one if you want. Free cash flow to market, and that's why like ratios are great. Like free cash flow to market cap is a great. Just cut through the noise. How expensive is the stock on a free cash flow basis? So I have to confess though, I don't know what like the S&P would be. Maybe that would be a better one, right? Obviously, SP doesn't have free cash flow because it's not the SPY is not a stock, a business, but it should have like free cash flow of its holdings, right? Does it have that? I'll be honest with you guys, I don't even really know. Maybe let's find a less expensive example. Let's do like all right, let's do, you know what? Let's do IBM. Because IBM is holding up here, right? Like the stock is holding up. I'll bring it up on the screen so we can see. IBM as a stock, I bring it up on the screen and you see it and you look and you say, wow, IBM is amazing. Well, what is the market cap of IBM? $121 billion. What is the free cash flow of IBM? It's $8 billion. So what did I say? 121 was the market cap and 8. So what is, well, 8.5. So 121 divided by 8.5. 14. 14 is your free cash flow to market cap number on that, which is obviously cheaper. So S&P should be around 14. Oh, right where IBM is. Look at that. All right, so there's your bogey, 14. The reason why, again, like ratios are only useful when you compare it to something else. If I told you something had a free cash flow to market cap of 12, that in and of itself means nothing. It's to compare it to something. Compare it to the S&P, compare it to one of its peers, just compare it to something, right? Oh, it's exactly at 15. There we go. All right. So let's just say, for the sake of simplicity, any stock trading at a free cash flow to market cap multiple of below 15 is quote unquote cheap. And I'm putting that in quotes because what it's really saying is it's cheap relative to the overall market. Anything above 15 is quote unquote expensive, i.e. the stock is valued more than the overall market is on a free cash flow basis. And I'm just going to assume, I'm going to make a broad assumption here. Yeah, I know it depends on the business. I'm just making a broad assumption here that stocks that are at free cash flow to market cap of 30 or 40 or 50 are going to have to come in a little bit. They got, like, without even looking, I'm sure AT&T's is very low because all their ratios are crazy low, right? Like what's the forward PE of 7.5, 7.5? That's what's the S&P at? 22, 21? AT&T's at 7. I don't actually know what the S&P is. The historical average is 15. I know it's come off that. It was like 25 last year, but it's not now, obviously. AT&T is a cheap stock. Does it make it a good stock to buy? Well, I mean, right now. And again, I'm trying to do this in a simple way. My chart is not behaving. I'm trying to be simple about this. Why is my chart just sucking all of a sudden? Hold on. When in doubt, do a refresh. Oh, I got booted. I got logged out. That's lame. All right, I have to log back into my platform. Such is life. Yeah, debt to free cash flow too. But as I was saying though, when my chart decides to work for me, there it is you can just look at the relative outperformance. We talked about there being nowhere to hide. There are some places to hide. You just gotta look for them, really. This is actually a great use case, or great reward use case for the screener tool in Benzinga Pro. If you haven't used a screener before, wait, do we sunset the screener? I think we sunset. I think we're revamping it. So never mind on the screener. Let's check on our scanner though and just see what's what for today. I want to look at Palantir just quickly. Holy moly, $7. Dear Lord. Some of these stocks, we're going to look back in 5 years and say, I can't believe I could have got it for $7. I can't believe I could have got this stock for that price. What a steal. We don't know who it's going to be, though. It's probably good to have some stocks like that whatever you want to call it, a moonshot, whatever it is. Like, if this thing hits, is it going to be good if it hits, right? Like, I have SoFi. If SoFi hits, even though it's a small piece, oh man, that'll be awesome. I don't own Palantir. I have traded it in the past. I don't own it. But this would fall into that category of a moonshot, right? Where if you own this stock, you need to have a conversation with yourself, and you need to acknowledge that there is a very good chance that you're not going to see any returns for quite some time, like several years. I'm talking about. Because if you're expecting to get your money, if you think Palantir is going to 20 like this year, you're lying to yourself. Because it would take an act of the market gods to get Palantir to 20 this year. Palantir is meme trash, though. Maybe they are, maybe they aren't. I don't know what this company does still. No, it's like the NSA, but public. All right, that was your big loser of the pre-market session, though, which is why I wanted to bring it up. Do we have any anything? Oh yeah, how was Tyson doing? Because that was like your one leader, your one gainer, Tyson Foods. Because they had earnings this morning, right? Y'all still eating chicken? I'm still eating chicken. Last I checked. What were the numbers? Actually, no, I don't care about the numbers. Okay. I'm taking another poll. Should I just stop reading numbers? Like on pre-market prep or whatever, should I just stop reading earnings per share and revenue? Because as we just talked about with Tom Fennimore, in a contracting market, EPS is virtually meaningless. Revenue is even more meaningless, right? Like I read you that stat this morning from FactSet. Like 75% of all the it was 80. It was 80% of the companies that report earnings so far have come in above estimates. But like you wouldn't know it by looking at the stocks. I read them out of habit. I read them because it's good to get an idea for whether Wall Street's expectations were out of whack or not. But yeah, they are totally meaningless right now. Maybe I should just stop doing. Maybe I should just say so and so report earnings. The stock is up. The stock is down. I'll just say I lived on Tyson chicken in college, so. By the way, do we have any DC people here? People in the DMV area? Because I was there over the weekend, and I got to say, I was blown away at the sheer quantity of Truist bank branches that I saw. And I know they did the merger. It was BB&T and SunTrust, and they merged. But you couldn't go 2 blocks without seeing a physical bank branch for TFC. And who still goes to the bank? Does anybody go to the bank still? No, of course not. Capital One's converting their banks to cafes. I probably saw a dozen Truist branches. And I was in like a 2 square mile radius. Madness. Walton, how many Truists are near you? There's a lot, right? It's like, what are they gonna do with that? What are they gonna do with all those branches? I know it used to be BB&T. There's no way they can last, right? I know it's like the 6th or 7th largest bank in the country. The ATM, yeah, that's it. Use it for the ATM and nothing else. No reason to go inside. Yeah, I don't even know the last time I've been at a bank, honestly. I couldn't tell you. Oh, wait, no, I was in a bank in November. So, once in the last 6 months. I don't know. Banks are online, just like menus. All right, it's 12:56. Keeping one eye on the market here, and we're gonna have Jake Wujastyk from TrendSpider hop on in a few. He is much better at the technicals than I am. I am not a technicals guy. I like my support. I like my resistance, and that's basically it. I love the way Jake uses Anchored View app across, his charts. I love that. So he'll be on in a few. We'll run through charts. If you have any tickers for Jake, please put them in the chat. We'll ask away. And then at 1:30, we'll be joined by Shawn Cruz who from TD Ameritrade, he has a pretty good view of the economic picture, what the data is telling us right now. From just an economic data front, we of course have CPI on Wednesday. That's the big number. By the way, how is the jobs number on Friday? I have no idea. I told you guys I wasn't here. I have no clue. Like how the job. I know it came out. That's about all I know about the. Does the jobs number even matter though? I don't even know if it does. CPI is more important. I'm guessing it. Oh wait, look at that. You can actually see in the SPY. Oh, what a surprise! We popped on the number, right? Then we gave it back. Then we reversed again. Then we reversed again. Trading is hard. That's why I don't really do it, honestly. I do it a little bit, but man, is it hard. So freaking hard. Do you miss any news today? I've been on with y'all. I have not been paying super close attention to the news. We have any midday headlines? I guess I should go look at the scanner would tell me, right? Because it tells me what are the biggest gainers of the day. All right. BIG. What's going on with BIG? I don't know what that is. Oh, yes, I do. Big lots. Duh. Nothing. Vizio. We got news there. Oh, they're speaking at a. No, that was. No, they're not. No news there. Whoa, why is Corsair up? Wait. CRSR? This is from the open? Oh, they had earnings Thursday after the close. And their guidance came in way below estimates. You'll love to see that. So it's bouncing today? Yeah. A little bit there. That's interesting. Newell Brands. Staples, right? Consumer staples. Newell Brands is in the green. They had earnings on Friday. Nope, that was several weeks ago. Never mind. Is there anything that jumps out to us here? What about on the downside? Hey, BHC. Man, I wish Matt could join today. BHC. Isn't BHC is doing the spinoff? That's today, right? Or tomorrow? Or no, that was last week. The spinoff. Man, I wish Matt was here. Permaculture now. That I believe you. I believe what you heard, and I am here to say that what you heard will inevitably change 30,000 times between now and the end of the timeline. That storyline, because it's already reversed a dozen times. It's reversed a dozen times. Oh, they're delisting. Oh, they're not. Oh, they are. Oh, they're not. So whatever you heard on Friday or last week is going to change, because that's what happens with that. With that story, it reverses constantly. Otung Glenn is asking about AMC. Yeah, they report earnings tonight. Let's get Jake's thoughts on AMC, among other stocks. Let's bring Jake Wujastyk on now from TrendSpider. Jake, how are we doing?
Doing well. How are you?
Doing fantastic. How was your weekend? Do you have nice weather? Because where I was, it rained the whole time.
Yeah. It was nice weather in Denver. A little windy, but that has been the theme for a while now. So all in all, great weather and a good weekend.
It's been a cool spring. I mean, for me in Michigan, it's always cold, but I feel like it's been just a cool. It hasn't really got warm yet this week.
Yeah. I mean, honestly, in Denver, usually have one more snow in May, and I don't think we're going to get it this year. So I'm not mad about it. But
nice.
But nice. It's been nice. I just hope this wildfire season kind of doesn't start up too quick. So
Yeah.
But yeah, no, excited to get over to Vegas. You always have
man.
good weather in Vegas, so
That's true, man. It's going to be good weather. Sure of it. And in the meantime, though, let's talk some stocks. You were tweeting up a storm this morning, as you are wont to do. You were tweeting about what I see. I saw Nvidia. I saw the Qs. I mean, with you, it's probably we always typically start with the SPY and the Q, so we'll start there. But tell us what you're seeing here.
well, I mean, it's kind of been a progression of what we've been talking about the last couple of weeks. We've been talking about the gaps, and the gaps are filling. SPY just filled its gap from way back here in April of 2021. So, I think we've been talking about the gaps for like the last 2 or 3 weeks. So they're just kind of doing their thing. Most people who are invested in the markets don't want to hear that, but unfortunately, with rates the way they are, they just keep rising. That you're gonna just kind of see this, and I hate to say this, but it just seems like the bubble's starting to pop. I mean, you see this across the board. It's not just the broad markets; it's crypto, it's growth. I mean, growth has continued to get destroyed since last March, but I mean, it's just similar charts around the board. I mean, you've got the S&P 500 that just filled the gap. We're breaking down through this trend zone. The Qs breaking down. We talked about this gap below, I think weeks ago, around 277 that could fill. Now, whenever I mention a gap below, that doesn't mean I think it's going to fill tomorrow or the next day. It just means that now that we're breaking down through these levels, it makes sense that this would be the next level below to watch. And so for me, the Qs, maybe you get a little bit of a bounce over the next couple of days to retest this previous support, now acting as potential resistance. But there's nothing, on any time frame that really suggests this is over. You've got earnings season coming in. You've got a lot of names that are going to be reporting, and that could be the next kind of leg of selling that comes in. I hate to be the bearer of bad news. I hate coming on here and just being bearish, but there's really no reason that the trend would reverse at this point. You don't have anything macro that pushes this higher. I mean, you look at prices. If the Fed backed off on interest rates, prices would continue to rise. I mean, you go look at airline tickets, you go look at anything right now, and it's just insane. So the only way they can stop this is to raise rates. And when you raise rates, that makes the market look less tempting to get into, because you can essentially put your money in less risk-free or more risk-free assets such as fixed income, and you'll see some of the stocks do okay. MO is one. MO has a great dividend. That's why it's doing decent, because it can compete with rising rates. And so any stocks that have any stocks that have high dividend yields, they're going to do okay in this rising rate environment. But your growth names are not adding any type of value. Most of the time they add value by gaining capital gains, over time. But when they're getting hit, there's no reason to put your money there. So you just have this liquidity vacuum, just sucking out all liquidity in the markets, and they're going to fixed income. Now, if you look at the 10-year, which is just TNX on TrendSpider, this is what's really interesting. You'll notice that actually the 10-year is actually down today with the markets, which is intriguing. But the bigger thing here is the fact that we are breaking out of this like 40-year downtrend on the 10-year yield. That is pretty remarkable, and definitely a little bit of a status quo changer here for the markets. And so, just keep an eye on the 10-year and other yields, but this is definitely one a lot of people watch. And generally, when you have, look at the 10-year yield from the COVID low to now is up 700% from the low. Now, let's take it from around this just this trough. It's still up almost 400% since the COVID beginning. That is going to cause, and already is causing, some massive issues in the credit markets. You're getting these just you've got this deleveraging occurring across the board, across the world, really. And the markets are doing what you'd expect when that occurs.
The biggest takeaway that I'm gathering from you, and I agree with all of it, which is like there is nothing to suggest that the trend will change. And that's true. That's true from a fundamental standpoint, and it's true from a chart standpoint, right? There is just not, if you're looking for a reason why we're going to turn, you can tell yourself anything you want, right? You find a reason. If you look hard enough, you'll find one, probably something to tell yourself, but there's nothing real out there that really signals we can stop going down. That's true across the board. So,
one thing I've seen on Twitter a lot lately is, well, they've got great earnings. They've got it. The market doesn't care about earnings. The market cares about forward-looking events and things like that. And that's the issue. Is sure they have good earnings, but what about when everything kind of starts squeezing and the economy really starts to feel it? I mean, go look at a flight. I used to be able to get a flight back home to North Carolina during this time of year, I don't know, $350, $400. Right now, it's almost $900 for a decent flight where I'm not leaving at like 5 in the morning. I can't even imagine what you guys had to pay from Michigan.
Dude, you don't want to know.
Yeah, so that's my point. And eventually that does start to hurt demand, right? People maybe still have some disposable income they can work with, but that's going to start to slow down. You're going to see it across the board, and that's kind of what has to happen in order for prices to get under control. I mean, prices are out of control. I went to the store yesterday and I was like, what? Like, they just keep going up. It's insane.
I know.
So,
well, that was like when I was like, I flirted with the idea of going to Omaha for the Berkshire thing, and this is like I think they announced it in February, right? So I was like, all right, let me just throw on like a Google flight alert, because I know that the price will go up, and then at the very end it'll probably go down, and it just never went down.
Yeah,
I was like, damn. So
yeah, it's tough. I mean, you've seen it in Bitcoin. I think Bitcoin is going to be the next one that goes. Now, that may sound crazy considering we are already down like 50% plus from the highs. If you look here from the highs, we're down 55%. But I mean, you look at a lot of the Twitter kind of posts about Michael Saylor having a specific price at which he's going to get margin called.
Dude, that's nuts.
I think Bitcoin is going to really show everybody really quickly how over leveraged people are, because that leverage really stems in these high beta, high risk names, Bitcoin, Ethereum, these crypto names. I wouldn't be shocked if you have a flash crash on Bitcoin this week to like the mid 20s.
Well, what does that mean? What's a flash crash in Bitcoin to you?
It means that people hit their margin. They essentially get a margin call. You have to have so much liquidity in your account, and once it's called the maintenance margin, you have to maintain a specific amount of liquidity in your account. As soon as that goes below whatever threshold you have in your account, broker says, you're like, oh, I don't want to sell it yet. Broker says, I don't care. You owe me money, and we're selling it for you. So you essentially have forced selling, and that's what occurs during these crashes. Is it's not like, oh, everyone panics together. It's everyone's forced to panic together, and they're not panicking because they're scared the market's going to go down. They're panicking and they're forced selling because they have to sell. They have to maintain a specific
right. But I guess in terms of the price, though, like what is a flash crash to you?
Oh, like price level? Like what would you?
Yeah.
I would say like this previous high here.
Okay.
I mean, I think Michael Saylor's margin kind of level is like 21K. So wouldn't shock. And who knows, if he's kind of like a smart dude, maybe he would sell before that and not get forcibly liquidated. But you can see here the COVID low VWAP is something that we've been watching now is starting to break down. So Bitcoin's at 31.4 right now. It was at 2,500. That was your real threshold. So, you can't just go down to 19 or 21. You have to go through different levels. So if we were to look at a basic level to break, $30,000 is just a psychological level. It's also an area that we've tested multiple times here, from this December and January kind of open and close in 2020, and then this low in June and then July of 2021, right around 20. And that's the thing with Bitcoin. You can't just say, oh yeah, I think it's gonna be 29.5. I generally have to give Bitcoin like $1,000 margin of error, because there's just so much over leverage and just emotions in crypto. I would say 29K to 30K is your next level to watch below. Based on how Bitcoin's acting right now, I wouldn't be shocked if it hits it like tomorrow. If it doesn't, people are like, oh, he was wrong. That's fine. But just the way that the market is acting right now, it wouldn't shock me if we just get a massive just deleveraging event in Bitcoin and across the crypto world.
Possible. Jake, it's no secret that there is an epic amount of leverage in the system. Everyone knows this. Yeah. Everyone admits this.
Yeah. So we have one thing I'd mention here is, right, you got the COVID low VWAP. That is this solid blue line. So we're breaking down through that. But then you also want to take the December 2018 low, and what's the volume weighted average price from there? Well, it's right around 25,000. So those would be the main areas for me. In order to get to 31,000, you need to get through 31.4. You need to get through 31.3. So you have to get through all these areas. But the levels of interest that I would be watching are this initial. Let's just make this blue. Or no, we already got a lot of blue. Let's make this green. Not green because we think it's going to bounce, just green to differentiate it from the other colors. So green would be your first level. Let's call it 29,000. This is just a previous low that we had back in June of 2021. If we break down below that, then the December 2018 low volume weighted average price is right around 25K. Let's call it, give or take $500 on either side. If that breaks, then I would anticipate a move to sub 20, because that's when you really have a lot of these. I hate to say countries. I mean, look at old El Salvador.
El Salvador, yeah. The El Salvadorian balance sheet is not doing great right now. I'll tell you that.
Yeah, Michael Saylor. I mean, he's actually kind of taking it with some humor here. I saw his McDonald's post this morning, but I mean, he's going to get liquidated if things continue to move like this. And then at that point, I think you're going to flush out a lot of the leverage in the market. But, before we get ahead of ourselves, we need to hold 29K. And until then we're kind of still in the status quo that we have been in for a while with that June 2021 low right around that level.
Someone in the chat asked about the logistics of a margin call. So full disclosure, I've never been margin called, but I would imagine, I'm assuming, that a margin call for me and you is very different than a margin call for Michael Saylor. A margin call for me and you is probably they go into your account, they sell it, and you're done. A margin call for Michael Saylor is probably like, hey Michael, we're gonna sell, but before we do, we'll give you till the end of the day today to find the capital to satisfy your requirements. I'm just guessing here. I'm just going to assume that the margin call, it's like most things on Wall Street. Depends who you are. Depends.
Well, yeah, I mean, you mix a margin call of that size with a low amount of liquidity to absorb that supply that's going to come on the market, and you've got
recipe. Problem. Yes, recipe for disaster, of course.
So we, I'm kind of sitting on the sidelines watching for the most part, and I'm just kind of, eating my popcorn. So we'll see what happens. I really hope, this stuff doesn't happen, simply because there's a lot of people that have put a lot of their life savings into this stuff, and it's going to wreck a lot of people. But at the same time, we just have to look. I mean, you've got this topping formation. This topping pattern isn't like it started yesterday. This has been happening now for a while. Your biggest what are we on the monthly? So I'll go to the Williams percent range 12. This was your biggest red flag here. You had these higher highs shown by this arrow up, right? And then you look at this oscillator, which is the Williams percent range. This is kind of what I gauge for the most part for divergence. This divergence has been playing out now for like a year. So it shouldn't necessarily come as a surprise to people that, this is just starting to play out. But like I said, we can't get ahead of ourselves. We can't start talking about 25K or 19K until we break this previous low here. All of this is an if-then statement. If we break this previous low from June of 2021, then the next level to watch below would be this area that I'm going to highlight in blue right here. It's simply just the low from 2018. And then we reevaluate. There's no reason to get ahead of ourselves and say, this is going to happen, because you can't say this is going to happen if 3 other things have to happen before that.
Yeah.
But I do know that there's a lot of leverage. There's a lot of people who got way overexposed in this market, not only the crypto market, but the stock market. And it's gonna show. And I think we're getting into a seasonably weak time of the year. Sell in May, go away. It's not the first time people have heard that one. And we're definitely seeing that right now.
But Jake, we just sold in April and March and February and January. So, but I want your point too about people being wiped out. Like you can be bearish. I mean, I think Jake was pretty bearish before. I've been bearish more or less all day as well, and you can be bearish, but don't be a dick about it, right? Like there's a difference between being bearish and like rooting and just being like rah on the way down, because people are getting wiped out here.
Yeah.
And that sucks.
Yeah.
And some of it is they took risks they shouldn't have, but it still sucks. Don't be that guy rooting for people to lose their money and screaming on the trash heap. I was right. Nobody cares. Nobody cares. Nobody cares.
That's one thing that drives me crazy about Twitter, is just how many people, and even not in the crypto markets, just in general. Oh, I was right. Look at how I just sniped.
Nobody cares.
Yeah. That's honestly why I sometimes just take a step back from Twitter, because I'm just like, man, this is cringeworthy. But yeah, like you said, I really hope what we just talked about doesn't happen, because if that's the case, then there's a bigger issue. I think with the plumbing of the system. You've got a lot. Deleveraging just means that everybody that was leveraged is now going to get essentially wiped out, and that's going to cause problems for people who are rooting for it to go down, unless they're just like a god and they can just trade perfectly. But this is definitely starting to play out. This is kind of that straw where you want to look at where's all the leverage. It's here, and then the thing about, I was actually just looking at the housing market and just kind of prices, and they're insane right now. But the reason why they are so high isn't because I don't think the same reason that you had in 2008. The reason why prices are so high in the housing market right now, one, obviously money has been really cheap from low interest rates, but there is no inventory. All of these builders couldn't go build a bunch of houses because lumber was so high. So, there's just not inventory in the housing market. So, is the housing market going to follow after, all these other leveraged assets kind of deleverage? We'll have to see, but it is worth noting, we may see this domino effect across different parts of the economy if things really start to get hit. But all in all, I hope it doesn't happen. But with prices the way they are, you go to the grocery store and you come out with 5 items and it's $100. It kind of has to happen in order for that to stop.
Yeah, that's true.
I wish I could have a better thing to talk about here, but it's just one of those things where price action is really telling us the status quo is changing.
Jake, let's look at some individual stocks here. If you have a ticker that you want thoughts on, technically you like it for the upside, you like it for the downside, you like it to consolidate, either way, shape, or form, drop it in the chat. We'll have Jake take a look at a few of these. Let's look at, someone asked about AMC. They report earnings tonight. And I don't know how I don't know. It's AMC, so it is liable to meme. But of course, we're not in that kind of environment right now. So I'm inclined to say we're not going to meme. And I'm inclined to say, here's what they're going to say. They're going to say that the business is getting better and better and better and closer and closer and closer to where it was before the pandemic. That's what they're going to say. They're going to say, we're almost there. We're almost back. We're like, I don't know, 85% of the way back to where we were pre-COVID. Of course, the global box office has not recovered at all from COVID. I don't think it will. But they're gonna be bullish. If you want to hear bullish things about AMC, tune into the call. They will be positive. Does that translate to the stock going higher? Probably not. Jake, do we have any levels to lean on?
Yeah, so I mean, look at PLTR right today. PLTR, everyone's like, "Oh, that was great earnings," and then it's down 20% on the day. So, for those that are in AMC, I hope it goes up for them. I'm definitely someone who has a backbone. I don't want people to lose money and get wrecked. But there's two sides to the market, right? You're either going to make money or going to lose money. So, if we did kind of break down through what I'd call an incredibly rough looking descending triangle. I don't even know if you can call it that. That's just kind of what my eyes just saw quickly. Then, just naturally using basic support and horizontal support and resistance areas, the next level below would be around $9. You can't even really use a VWAP here because there are no VWAPs below. You're below all of them. So the COVID or the January 2021 low is way up. VWAP is way up here, like 25. So what does that mean? It means this blue line is essentially the dollar cost average of all shares that have been transacted since January of 2021. That means on average, the average holder from January 2021 right now is down about 50%. And so what that means is you've got a lot of people underwater. So even if you do have some big move to the upside, you're going to have a lot of people probably just trying to get out with whatever they can. If you measure the volume by price from this January 4th low, we are starting to get to an area where, there are a lot of shares that are kind of break even here. Now, it's not the average because as we just showed with this blue line, which is the volume weighted average price of the January 2021 low, you're, on average, people are down 50%. But you can see there's a lot of shares that have kind of been transacted here that may create a base for price. But if you look at other examples over the last few weeks, you've seen these areas literally just like get sliced through like butter. So, it is going into the 6th potential red week in a row. If this thing were to really tank, your point of control, the point of control is essentially where the most shares have been transacted from a specific point in time, is actually right in line with this general area right here too. So I'd say $9.50 to $10 is what would make sense to me. If this really, and even if they have good earnings, I'm just not sure if there's enough liquidity in the market to push it up.
I agree with you. I agree with you 100%. All right, a few more tickers here. Let me scroll up, see if I missed anything. I don't think I did. Okay. What is DT? I don't. Do I know that? Do I know what DT is?
Well, no, I know that it's not looking good on the chart, but I don't know exactly what it is.
I don't know if I've heard Dynatrace. I don't know if I know what that is.
See, like the thing is, before we were really worried about these pivots, right? So here, that's one. Here, this is your COVID low. We were really focused on, okay, where are the volume weighted average prices below? Well, the problem is with a lot of these names, we're below those areas now. So it's like the average participant from these lows they're losing money. And that's never a good equation for any type of like long move to the upside. Generally, like, sure, you could get something like this where you move back up to where the average price is. What happens when you get back to average after being in a huge drawdown? You generally at least lower your exposure or you sell out the whole position. And enough people do that, and you just have a massive wall of supply up there. I mean, look at Ethereum. I mean, if you want to play like leader versus laggard right here, we just talked about Bitcoin is at the COVID low VWAP. if you want to look at like a leader versus laggard idea, the COVID low VWAP for Ethereum is still way down here at like 1850 to 1900. So there's not a lot of these names still left that are actually above their COVID low VWAPs. This is one of them, but as we just saw in Bitcoin, that's already been broken. So Ethereum is generally kind of a follower of Bitcoin. Either Bitcoin will do its thing, Ethereum follows, or Ethereum will do its thing, Bitcoin will kind of follow. So it's just, you want to use a point of reference. And in this case, maybe you start looking at the COVID low VWAPs on any stock you're in and see, okay, are we above it? Are we below it? And then kind of get a general idea. Is the average participant that's traded this and essentially the dollar cost average since the COVID low, are we above it or are we below it? And even if we are above it, that means people still have profit they can sell. And generally you're going to mean revert back to that level. So, I just wanted to point this out because you can use these VWAPs across different areas. It's like, okay, well, Bitcoin's at its VWAP from the COVID low. Why isn't Ethereum? Okay, maybe Ethereum's lagging. Maybe that's a trade that I can take to the downside that kind of is almost like there's nothing guaranteed in the market, but if it's going to follow Bitcoin, we already know where Bitcoin is in relative terms to that COVID low VWAP.
All right, let's do a few more here with Jake. Let's do Kraft Heinz. Like in theory, it's a consumer. It's a KHC. Sorry, KHC. It's a consumer staple.
Yeah,
it should be outperforming. Oh,
and it
I
is.
didn't realize that. Oh, okay.
Yeah, it looks great. I mean, it's up almost 2%.
Wait, what's the price? It's hard to see what the price is on that. What's the price?
44.50.
We're in the 40s.
Yeah.
No way. We're back in the 40s on Kraft Heinz.
Well, look at the dividends. I mean, people are probably just buying into getting a dividend.
Oh my goodness.
So let me
wow.
Let me throw this on real quick. I just want to see what the dividends actually were.
And then what is that high? The high from a year ago was 44.95, damn near 50 cents off that. The dividend yield on Kraft Heinz is 3.7%. Yeah,
so I mean that's beating the 10-year. So
yes, it is.
So that's why people are buying it. So yeah, I mean anything that has a higher yield than the 10-year, it's likely going to be bought up until the 10-year gets to their yield. Then then the market kind of does its own thing. But yeah, it actually looks remarkably good right here. You look at the monthly chart, and I mean this actually looks like a very strong chart going into the second half of the year.
Yeah.
If you look at everything, if you look at the VWAP from this high, we just broke through it. That is a huge deal right here. I mean, look at how many times this acted as resistance. So if we just highlight this area, so you can see here we rejected back in 2021. You can see here that we had trouble getting through it after we initially topped out in 2017. So yeah, I mean, the fact that we're actually possibly going to close above this on the monthly chart is huge. So yeah, this is a really solid one to look at. MO is another one. That's Altria. They've got a pretty high dividend. Doesn't look as good, but at the same time, its highs are way up here in the 70s. So it's at 55. It's got a decent yield. People are going to be smoking probably more cigarettes the next couple months with how things are going.
I presume so.
So it's just one of those things. I mean, you look at just a basic resistance trend line here. We're breaking out of some pretty important levels. So it's not shocking to see these names with higher dividend yields doing what they're supposed to do during these types of rising rate environments.
All right, Jake Wujastyk is one of the founders and the CEO of TrendSpider. And Jake, the next time you and I speak, we'll be in person in Vegas on Friday. So I'll see you there. Looking forward to it, my man.
It's been a while. And just to correct you, I'm not the CEO. That's Dan.
I apologize.
Dan definitely takes the cake for that. There's no way I could do what he does. So shout out to Dan for really making this company what it is, and along with the rest of the team, right? It's a huge team effort, but I did want to mention that. But we'll definitely see you in Vegas.
We will. Use the code that was on the screen for a half hour, BZ25. Gets 25% off your TrendSpider. Jake, I'll see you later. Let's bring on our last guest of the day. He is from TD Ameritrade. His name is Shawn Cruz. He is the head trading strategist. Here he is. Mr. Cruz, welcome to the show. How we doing? How's your weekend?
The weekend was good. I was hoping the week would start off a little bit better than it is.
Nope.
And I was, it was kind of sad. I was home spending Mother's Day with my mom. And, as we're creeping towards futures market open, I found myself just looking down at my phone and almost counting down the minutes until the market was open. I really wanted to see how we were going to open yesterday.
Well, it wasn't great. Yeah. Well, I don't know. Let's start with this. Every single month, TD Ameritrade, you release this metric you have. You have this proprietary data. You call it the IMX, right? The Investor Movement Index, and it's, as I understand it, it is your way of gauging the sentiment, of gauging the amount of fear in the system amongst your clients. Is that right?
It is, and it's nuanced.
Okay.
We look at clients that placed at least one trade that month, and then we don't just look at it as did they buy, were they selling. We kind of take a look at exactly what they were buying, what they were selling, and we make some adjustments for the volatility of those assets to get a gauge of just really what their thoughts are, how they're feeling when they're going out there and making a decision. Because the decision to go out and buy, a volatile, high growth, high PE tech stock is not the same thing as making the decision to go out there and buy, the safest utility you can find.
Right. So when I show this chart up on the screen here, what does this mean? Like, so we've got the IMX here. And it kind of shows that what we're looking at is we're looking at like a 7-year chart, 8-year chart of the IMX. And you can see it had a big spike in the end of 2017. It had a big spike in 2020, 2021. It's come off since then. What does that mean though?
I mean, what it means is investors, as we've been looking at how they're viewing the market, what their outlook is, they've been really dialing back that exposure. If you look at where it peaked out here at the start of the year, it sort of fell, I think, a little bit faster than the market was able to pull back. So I think there was a little bit of a shift in sentiment ahead of that. And I think the market understood some of the inflationary forces that were building, the expectations that we were going to get peak inflation in January, the Fed was going to hike 2 or 3 times. Once that sort of that notion started getting called into question, be it because what we were seeing with the escalation of the war between Ukraine and Russia, or what we're hearing just in commentary from the Fed having to be a lot more aggressive with tightening policy, I think investors knew that it was a good time to go out there and retrench and lower some of their overall exposure to the market. That doesn't mean they were out there just dumping stocks as fast as they could, but it does mean they're avoiding some of those more high volatile, frothy types of names that maybe were doing okay in a market being juiced by Fed liquidity, just a lot of demand for equities in general. That's just a rising tide is going to raise all ships, so to speak. I think once you saw them become a lot more particular about where they're putting their money to work, that was where you saw them, like I said, retrench into some of the names that maybe aren't as frothy and volatile as names that say, don't have earnings, aren't expected to have earnings anytime soon, but they've got a cool, cool pitch or a cool business use case, but they're just not seeing the path to profitability. Those are some of the first names you saw a lot of investors, I think, exit here to start the year. And now it's just spreading more generally as uncertainty builds to pretty much across the board. You're seeing just a lot more of a dialing back of exposure.
So again, so what this is showing is that the TD Ameritrade clients that you're pulling data from are reducing the amount of stocks that they own in their portfolio. Are they making up for it in other ways? I know the IMX doesn't necessarily account for other other asset classes, or maybe it does. I mean, are they buying more fixed income? Are they buying more gold? I don't know.
So one thing is, even though you've seen this come back, they've actually been, net buyers to some degree or another of equities. And so that's why I think the nuance is interesting that comes in here, because if you really look back and say, look at some of the energy names or some of the industrial names, they've been highly volatile. And in some cases, you're actually seeing some of those names are more volatile than certain names in the tech space. So for instance, if you look at what they were buying, they were going out there and they were slight buyers in the tech space, but what they were buying, it wasn't broad based across the board. Sometimes even in months where they were actually net sellers of tech stocks or communication services stocks, they were still seeing some of the names that they were seeking exposure to the most were sort of those core tech names. Amazon, Google, Nvidia, Microsoft was a really popular one for the millennial base. And I think it makes sense where, look, maybe I don't want to go out there and find the potential maybe next big thing in some software as a service or whatever as a service we're talking about. Seems like there's a new one every couple of months. But they are saying, maybe I don't want to go there and roll the dice on that, because that's still highly uncertain. Profitability outlook isn't certain. Cash flow isn't good. But Microsoft, I'll take little bites of Microsoft as it's pulling back. It's on the way down. And those are the names we've seen consistently popular for clients to look at and buy.
How does that compare to prior months?
So the one thing is, this trend we saw actually began, I would say around April or so, where we saw them becoming very, very particular, where they weren't just going out there and seeking broad exposure to sectors. They were becoming stock pickers in terms of what they were looking at. And I always use the example of semiconductors, where you had months where you saw them, net buyers and strong buyers of, say, AMD or Nvidia. Those are always popular names, but they were maybe sellers of some of the other companies out there, like Micron or Intel. And it shows that they're really becoming very selective at the individual companies and the outlook for those companies as well. And the other thing you touched on alongside of this, even though there is some net buying of equities, we've been seeing some strong demand for fixed income. And I know your last guest was talking about, at some point are they now just going into some of those high yielding dividend stocks? I think that is also going to be something you see play out there. But I think what's interesting is, as you're seeing not just a 10-year move higher, but think about what that does. Most bonds out there trade at some premium, so some additional yield on top of what the 10-year is doing. So now you can actually go out there and maybe find a bond in Microsoft, Apple, some of those financials, yielding 4% or so, maybe a little bit higher. And I don't think it's impossible for someone to say, all right, I'll take that additional yield, 4 or 5%. That used to be high yield. They used to be the risky areas of the fixed income market, but I'm willing to put my money to work under the assumption that Microsoft or one of these blue chip companies isn't going to go bankrupt anytime soon.
Surprised to hear you say that, though, because yields keep on rising, prices keep on falling, and you can't hide in bonds for now. So I'm surprised to hear you say that your clients have been buying bonds. What maybe let's move away from the IMX for a second here. Looking ahead, we of course have inflation data out on Wednesday. That's kind of that's the bogey for the week. What else matters, though? Like, I guess what are you seeing from an economic data standpoint right now that is shaping the narrative to you?
The one big thing is, we've come out of that last Fed meeting. So there's going to be, I think, a lot of demand out there to hear what is going on with the Fed. I think people are still trying to shape what we heard in that press conference. Some of the jobs data that we got on Friday, they're going to have to pair that with what we get from CPI. But I think they're also going to want to hear from some of the Fed speakers that are out this week. And I think that is something we can't take for granted anymore. And I think if you look back at some of the days that really sparked some of these volatility clusters in the market, it's actually been Fed speakers. Usually, Bullard, I think Mester had one. There's usually a handful of Fed speakers that have the ability to spark either risk on or risk off in the market just based off some of their comments. And I think now that everyone's trying to get an idea of, do you really mean just 50 basis points? Or are we going to get a surprise 75? I think they're really interested in how that's going to play out.
In your best guess, Shawn, why do you think the market reacted the way it did on Wednesday to that meeting? It seemed, even in the moment, it seemed stupid. I'm just hindsight. I know, but even in the moment, it seemed dumb.
I mean, I think the market initially, there was this sense that we were going to front load those interest rate increases. There was also the topic of how they were going to start rolling off the balance sheet, how they're going to start letting some of that roll off. I think they didn't come in quite as aggressive as some market participants had suspected. So I think the initial response was we're going to have a dovish Fed. I mean, usually when you hear that, then you think, all right, well, then equities are a good place to be. But I think the market took a second look at that and looked at what was going on and said, if the Fed's already behind the curve, by not really seeming too concerned or having much of a sense of urgency as we thought maybe they were going to in tightening policy, are they going to get even further behind the curve here if we continue to get inflation doing what it's doing? So I think this is a market that isn't necessarily just saying, look, we're going to live and die by, the Fed, what they do, whether they tighten or whether they decide to keep things kind of loose out there. I think they're realizing some of this is more or less out of the Fed's hands, especially when you look at what I see as the two big drivers right now. The war in Ukraine, obviously, but then also what's going on with the lockdowns in China. I mean, you can tighten policy all you want. That's not going to improve, access to some of these supply chains that run so deep into China. But I do think the market, at the very least, didn't want the Fed to sort of enable demand to run too hot in the eyes of something where we're seeing China is really going to be, I think, a big burden on supply chains and a big put a huge bid in inflation until they're comfortable reopening things. And they've said we're still committed to zero COVID. They did come out and reiterate that over the weekend, and I think that's another thing that markets are concerned about, because that means you get a handful of cases and you're locking it down, and they don't really care what the consequences are, for their domestic economy, and certainly not for the manufacturing chains that run deep there.
Shawn Cruz is the head trading strategist at TD Ameritrade. He joins us every Monday. Shawn, it's always a pleasure, and hopefully when we talk to you next, markets are higher.
Take care.
All right. We got 15 minutes left in the show. We're doing something cool today after the show is over on Moon or Bust, which is, of course, our crypto show. I always wonder myself. I always wonder, hey, whenever there's a big crash, big correction or whatever, hey, what happened last time? What was the mood, the sentiment, the narrative? What were people saying last time this happened? Well, we're gonna show that to you today because we're gonna re-air an episode of Moon or Bust. So we're doing a replay, and the replay we're doing is from. Let me make sure I have the right date for you, because I don't want to give you wrong information. The replay that we are doing is from what date? What's the date on this one? From almost a year ago. Yeah, May 19th of last year is when this episode that we're going to air at 2:00, when it originally aired. And if you don't remember what was happening then in crypto land, Bitcoin crashed to 30,000 on that day, or right before that day. And so what we're going to do is we're going to re-air this episode that's 51 weeks old now. And you're going to see how the Bitcoin boys, that's what we call them here, the Bitcoin boys, Logan and Ryan, how they reacted the last time Bitcoin was crashing. Does it hold up? That's for you to find out. So that'll be at 2:00. I'm very excited to see that, because I always like looking back and saying, hey, how did I do? How did we do? How'd they do? Right? Last time this happened. Were they right? Were they wrong? Were they just totally out to lunch? You can just tune in at 2:00 when we replay an episode from Moon or Bust that shows how we reacted, or how they reacted the last time crypto was doing what it's doing right now. All right. Question in the chat about ARKK. I'll get to that in a second. Before we do that, here is the earnings calendar for the week. We are still in the thick of it on the earnings front. So tonight, AMC, Maxar, XPO Logistics, 3D Systems, Lemonade. Tomorrow, we got a handful of big ones. Peloton, it's their first report since the disaster. Kronos, Hyatt, EA, Roblox, The Trade Desk, Rocket, Unity, SoFi. A lot of big ones this week. Wendy's on Wednesday. Disney on Wednesday. Rivian on Wednesday. Beyond Meat on Wednesday. Affirm is Thursday. A lot of big names. We're going to be streaming. Let's see. I'm going to decide this right now. We're going to stream the AMC call tonight on YouTube, youtube.com/Benzinga. We're going to stream the AMC call. We're going to stream the Disney call on Wednesday. And I think that'll be all for this week. We'll just do AMC and Disney. Unless you guys want to do one on Tuesday. And these other ones. I'm open to it. So there's a question from someone, I forget who, about SARK, SARK. Will SARK keep going higher? Well, if ARKK keeps going down, then yes, SARK will keep going higher. That's how it works. But that is not to say that you should just buy SARK and forget about it, because we talked about this like a couple hours ago, right? At the top of the show. SARK uses leverage. It uses swaps to get the inverse leverage, right? Those kinds of instruments are not meant to be buy and hold instruments. They're not. Okay? They will degrade on you over time. They literally only work in trending environments, in like an uptrend or a downtrend. When the trend is strong, they work great. When the trend is choppy and there is no trend, they eat you alive. Okay, so if ARKK continue, let's pull up a chart. Let's pull up ARKK here. ARKK. All right. If ARKK continues to decline, then yes, SARK will keep on going. It'll go as high as ARKK goes low. Actually, it'll do more than that. Because just look, all right? ARKK, since SARK's inception in November, that's funny. So it's been exactly, 6 months? That's cool. So that's 6 months, great. 6 months of data. And ARK is down 65%, and SARK is up more than ARK is down. It's up 125%. But what happens if ARK bottoms out? Or if ARK starts to get really choppy, right? Up today, down tomorrow. Up today, down tomorrow. Then SARK will not deliver for you. So that's the take there. And the same goes for TQQQ. Let's pull up TQQQ. Okay? The same goes for all of these. And we'll talk about this more tomorrow, by the way, with Dave Mazza from Direction. The point here is to capture short-term trends. The point is not to do buy and hold. And it doesn't matter what the ETF is or the ETN or whatever. If it uses leverage, think short-term, please. I'm begging you. MF, there is no way. There was no way. Wait, are you referring to TQ? I assume you're referring to TQQ. There's no way that this is a good buy and hold. Okay? Because I'll echo what I said earlier, okay? You don't know what it's like to lose half your money until you lose half your money. Everybody that's buying and holding the TQs, congrats. In the last 6 months, you've lost 2/3 of your money. It's thinking 91 in November. It's 30 today. Please don't buy and hold long-term things. No, because here's the idea. This amazing performance, okay, it looks good in hindsight, right? But you didn't know in 2011 that the Qs were going to have like the best, that tech was going to have the best decade ever. You didn't know that. You didn't know that. If you knew that beforehand, then maybe. But you don't know the future, okay? So if the QQQs are going to go up 10% a year for 10 years, like they basically just did, I don't know, maybe it was more. I don't know, maybe what the return was the last 10 years. Then sure, but you don't know. I'm just telling you what pro shares themselves will tell you, what direction will tell you for their funds, which is that they're not meant to be buy and hold. That's what they tell you. I'm just telling you what they will say. I listen to the issuer. It's their job to protect you in some way, shape, or form. I mean, they're not responsible for your returns, but they're responsible for telling you what the risks are, and they will tell you straight up, not buy and hold. It does add up. You know what? Actually, let's talk about, here. I have an idea. I have a great idea. MF, please, let's do this. Come back tomorrow, because tomorrow we're talking with Dave Mazza. He is our head of product at Direction. He's not responsible for TQQQ, but he's responsible for many other leveraged ETFs out there. He knows his stuff better than I do. Okay, so come back at 1:00 tomorrow, and we'll hear from him, because I don't he knows way better than me, and I don't want to argue. I don't want to argue anyway. But I'd rather just do this with Dave, because we do have a recurring segment with Dave Mazza every single Tuesday at 1:00. So just come back tomorrow, and we can actually get into the weeds here, get into the nitty gritty. Because I can't get into the nitty gritty with you, but he can. All right. How are we doing overall market? Sorry, so let's just punt on that conversation, and we'll bring it back tomorrow. I enjoy that. I enjoyed disagreements like that. I'm not getting angry. I hope I'm not coming off as a dick, because I'm not trying to. But oh no, what a surprise. The pop was short-lived. What are we going to do here? Oh, we did fill that gap, didn't we? SMH, guys. Dear Lord. I got nothing. This is it. This is the day. You know what I got? I got a plug, okay? This platform on the screen is Benzinga Pro. If you haven't tried it for free for 2 weeks, you can do so, okay? Click on the link that I'm putting on the screen right now. Or you can't click on it. You have to type it into your browser, obviously, right? You can't click. But if you want a free 2-week trial, where's my link? There's my link. pro.benzinga.com. Free 2-week trial for everyone. If you want more than a trial, if you want a discount, there is a code, a discount code. It is in the description of this video. I'm also putting it on the screen, but it's easier if you just click on the link in the description. Okay? It's benzinga.grsm.io/Benzinga Live. That link, right off the bat, will get you 25% off the platform. If you don't know what Benzinga Pro does or what it can do, it's really a question of what it can't do, because it can do a lot of stuff, okay? We've got news feeds. We've got scanners. We've got charts. We've got fundamental data. We've got balance sheets, income statements, key data, short interest, okay? A lot of people ask us for short interest. We have short interest data in Benzinga Pro. We have calendars for earnings and IPOs and lockups. We have SEC filings. Create your own watch list. Trade ideas. The trade ideas widget. People are dropping their ideas in there all day, every day. We have a squawk. There is so much to this platform. I cannot explain it all in 2 minutes. I can't. This might help a little more.
Did you know nearly all stock price changes of 10% or more result from a single news headline? That's right. News headlines have a unique ability to drive stock prices up or down. These news catalysts create trading opportunities every day. All you need is a little help to reach out and take them. And if you're looking to grow your portfolio, it doesn't matter if your investment budget is small or big. An easy-to-read stream of news headlines will increase your opportunities to profit from price changes in the stock market, consolidate a knowledge-based investment strategy, and grow your portfolio. All you need is Benzinga Pro and its powerful news alerts, price tracking, and portfolio monitoring to make a positive change in your trading performance. We've already helped thousands of retail traders across the world, and they could not be happier. Increase your market knowledge, boost your exposure to big movers, and make informed trades before major price changes. The opportunities are all around you. Subscribe now, and we'll skyrocket your portfolio today.
There we go. pro.benzinga.com. Put the link up one more time. Free 2-week trial. Check it out. Seriously, check it out. Okay, I'm done. Look at that, Frank. He uses two things. E-Signal, which I don't know what that is, and Benzinga Pro. That's a wrap. Tomorrow, AB will be back. We'll ask him about his weekend in New Orleans. And I'll be back later for Out to Close, as I am with Joel O'Connor every single day, right here, 3:30 to 4 p.m. I appreciate you all so much for hanging out. I had fun. I had a few days off, and I had things to get off my chest. I have now done that. I feel better. We had some therapy, I hope. Maybe it was just me. I don't know. So do me a solid. Just hit that thumbs up. I do appreciate that. It sounds dumb, but it really does help us in the eyes of YouTube. I don't know why. It just does. And we're going to air that replay now of Moon or Bust from May of last year, the last time Bitcoin crashed till the 30,000. How did we react? That's what's going to happen right now. So I'll see you guys in an hour and a half, and stay green out there. Stuff.